Super Microcomputer Inc. Stock is up about 200% year to date. It's currently trading at about $254 with a market cap of about $13 billion. In this video, I'm going to talk about whether there is more room to run for this stock or not. Based on my valuation, I'm seeing a 72% gain in the base case with reasonable assumptions and 120% gain in the great execution case. And before I move on to the details of the valuation, let me first talk about what Super Microcomputer does and show some numbers. Super Microcomputer Inc. does not make chips. Instead, they develop and manufacture high-performance server and storage solutions. And their solutions range from complete server storage, modular blade servers, blades, workstations, full racks, network devices, server management software, and server subsystems. So this company is a typical computer hardware company, and you can see some of the products on the screen. For Q4 of 2023, they made about $2.18 billion of revenue, which represents 34% year-over-year growth. And for the full financial year of 2023 that ended in June 30th of 2023, they made about $7.12 billion, which represented about 37% year-over-year growth. The guidance for financial year of 2024 is also impressive. They're planning to make anywhere between $9.5 billion and $10.5 billion of revenue, which represents close to 40% year-over-year growth. The company is saying they can get to $10 billion of revenue in the financial year of 2024, right? Also, they're aiming for $20 billion of revenue in the coming years. They plan to achieve this $20 billion of revenue in the coming years with the 4 segments that are displayed on the screen. There is 5S, which includes software, service, switch, storage, security. Then there is total IT solutions, enterprise, OEM appliance/cloud. And then there is complete systems, and there is subsystems and components. As you can see on the screen, majority of their revenue comes from the complete systems and followed by total IT solutions. Operationally, they're planning to address this $20 billion of revenue opportunity. They have a plant in Taiwan, and they're also coming up with Supermicro Malaysia campus. They're also saying that the worldwide capacity currently is about 4,000 racks per month. With respect to the revenue mix, as you can see on the screen, almost 90% of their revenue comes from the server and storage system, which is actually a cyclical industry. In one quarter or 1 year, they will do really good, and the subsequent quarter or the year, they will not do that good. Since this is a hardware company, typically their operating margins would be very, very less, and that's the same case with SMCI because they have a lot of competition in this field. The operating margins are ranging between 8 and 13%, which is very typical. If the operating margins are ranging between 8 and 13%, the net profit margins would be much lower, right? As you can see on the screen, in the most recent quarter, they made about $2.18 billion of revenue. The gross profit is 17%, which is typical for computer hardware companies. The net income, as you can see on the screen, is about $193 million off of a revenue of $2.18 billion. So that's about 9% net profit margin, which is not too impressive. Again, this is a computer hardware company, so this is how their profit margins typically are. With respect to the number of outstanding shares, currently they have about 56 million on a fully diluted basis. The share count is not moving significantly, so it's safe to say that they do not dilute the shareholders significantly. But now that the stock price is significantly up, there is a chance that they could issue more shares and dilute the shareholders. But for the purpose of this valuation, I'm assuming that the share count will not change significantly. Before I give out the details about the valuation, I want you to understand that this is not financial advice. I'm not qualified to give financial advice. I'm simply recording my thoughts about SMCI stock. With respect to the valuation, I'm going to show 2 cases, one with reasonable assumptions, which will serve as a base case, and the second case with great execution. In the reasonable assumptions case, in 2023, they're on track to make about $8 billion of revenue. With respect to the estimated growth rate, I'm assuming 17.5% year-over-year growth for the next 4.5 years. Remember that they guided for a growth between 33 and 47% this year, but as the company grows bigger and bigger, it's hard for them to grow. In addition, this company is a computer hardware company which operates in a cyclical industry. Like I said before, some quarters will be good, some quarters will not be so good. This is not a subscription-based model software service where you have guaranteed revenue each month. This is a hardware company, so the sales would be good in one quarter bad in another. So in my opinion, 17.5% growth year over year for the next 5 years is reasonable. With that, they can make close to $15 billion of revenue in 2027. With respect to the net profit margin, I do know that they have a lot of competition and their operating margins are ranging between 8 and 13%. So I cannot assume more than 8% net profit margin for this company. With 8% net profit margin, they'll make about $1.2 billion of net income in 2027. For a hardware company that operates in a cyclical industry, typically the market pays a multiple of 15, but I'm willing to pay a premium multiple of 20 because they're showing me some growth in the high teens. With that, the market cap in 2027 would be about $24 billion. With respect to the outstanding shares, as I said before, this company is not diluting the shareholders significantly, so I'm keeping the number of outstanding shares constant for the next 5 years. When I divide the $24 billion of market cap with 56 million outstanding shares, I get a stock price of about $436 in 2027. Currently, they are at $254, right? So that represents about 72% gain in 5 years, which will beat the index for sure. Let me now show you a great execution case. I've kept the net profit margin and multiple the same as the base case, but I have increased the growth rate to about 25% year over year, which is very hard to do. But it's definitely possible if the demand persists in the coming years. So with that, this company would be worth about $31 billion in 2027. When I divide the $31 billion market cap with 56 million outstanding shares, I get a stock price of $558. Currently, the stock price is at $254, right? So that's about 120% gain in 5 years, which is very attractive. In conclusion, I'm seeing a 72% gain in the reasonable assumptions case and 120% gain in the great execution case. So overall, I'm actually neutral on this stock. If someone buys this stock, I think that's not a bad idea. At the same time, if someone avoids this stock, that is also not a bad idea. For my personal journey, I'm not going to buy SMCI stock because it's just not the type of stock that I like. I want companies with very high gross margins and not operate in a cyclical industry. I really hate companies that operate in the cyclical industry. So that's the only reason why I'm not touching this stock. But I will definitely think about this stock if the valuation is really, really compelling. Like in the base case, if I'm looking at a 2x. And for that, the stock has to fall to about $218, which may not happen. And I'm okay to sit on the sidelines if it doesn't get there. That's it for this video. Please let me know your thoughts in the comments. Thank you so much for watching.